Okay, now I'm going to do gold prices, and I'm going to do bond prices next too. So 2-for-1 deal on this video. Okay, gold prices. So the first thing we're going to do supply side shocks, then demand side shocks. Supply side shocks. Again, it's the basic, the same microeconomic model. You start off supply demand curves. You start off in equilibrium, and you have the market price actually is set at the intersection of the supply demand curves. Now we're going to shock the system and push the supply curve out. That's going to increase quantity, and the prices are going to fall. If you think gold prices are going to fall and you're forecasting that, then you are going to write forwards, write futures, write calls on futures, buy puts on futures. You are also going to sell short, write calls, buy puts on gold company ETFs and gold company stock. The other is if there is a supply shortage of gold in the global gold market, the supply curve is going to shift back, and that is going to cause the price to rise. If you're forecasting the price of gold to rise, you are going to buy forwards, buy futures, buy calls on futures, write puts on futures on the indices. For the gold company ETFs and stocks, you are going to buy on margin, buy calls, write puts. On the demand side, we are now going to shock the demand curve. And if there is a rising or a shock or rising demand for gold, that's going to shift the demand curve out and up, and prices are going to adjust accordingly. If you're forecasting the price of gold to go up, you are going to buy forwards, buy futures, buy calls on futures, write puts on futures. Gold company ETFs and stock companies, you are going to buy on margin, buy calls, write puts. So let's review. Oh, and the last is if there is a negative demand shock and demand for gold is dropping, and you're forecasting the price of gold to drop, then you are going to write forwards, write futures, write calls on futures, buy puts on futures. For the gold company ETFs and the stocks, you are going to sell short, you're going to write calls, and you're going to buy puts. So let's get into the factors for gold prices. On the supply side, what could cause the supply curve to shift out? Well, one could be a major discovery in gold from a mining standpoint. Also, there could be massive sell-off in the gold market because maybe China, or particularly Russia, is running out of foreign currency reserves and is going to need to sell off its gold reserves to get foreign currency to be able to pay its liabilities, its global liabilities. So those are basically the two big ones that I could see. On the demand side, which would cause gold demand to shift up, is geopolitical, geoeconomic instability around the world. If people are scared, they're basically going to sell off their foreign assets, and they're going to go into gold because gold is a store of value. It's safe. It doesn't generate income, but it is a store of value. And when things start to get unstable politically and economically, there is capital flight into gold. Gold also, demand for gold could also go up during inflationary or hyperinflationary times as people worry about the deterioration in the purchasing power of their, let's say, their dollars or their foreign currencies. Because inflation is eating into the purchasing power, they will flock to gold as a store of value and a hedge against inflation. And also, foreign banks, and really central banks, foreign central banks and central banks buy gold to be able to anchor their currency, to revalue or devalue their currency. They could be using gold reserves as a way to move the currency up and down. Let's talk about bond prices now. Let's start off with the supply side. So if there's a sell-off in the bond market, or the Federal Reserve starts to sell bonds through open market operations, the supply is going to shift out, and bond prices are going to go down, and interest rates are going to go up. If bond prices go down, or you're forecasting bond prices to go down, then you are going to write the forwards, write the futures, write the calls on the futures, buy the puts on the futures. You are also going to sell short. You're going to write calls and buy puts, either on the corporate bond ETFs, the corporate bonds, or the stocks for those corporate bonds. Because as the bond prices go down, interest rates go up, and stock prices go down too. So you could do it that way. If there is a restriction in bonds, or the supply, there's not enough supply in the marketplace, that's going to shift the supply curve back, and prices are going to rise because of the shortage in bonds. If bond prices go up, interest rates go down. Right now, we're hearing about shortages in long-term bonds because everybody's issuing short-term bonds because interest rates are so low on the short end of the term structure or the yield curve. So if you think that bond prices are going to go up, you're going to buy forwards, buy futures, buy calls on futures, write puts on futures. You're going to buy bond price, bond ETFs, and the stocks of those companies. You are going to buy on margin, buy calls, write puts for both the bond ETFs, the bonds, and or the stocks of the corporations. Okay. So what are some of the, let's talk about the demand side. So increased demand for bonds will shift out the demand curve. Increased demand for bonds, let's say the stock market is starting to tank and it's starting to, we don't think earnings growth is going to be high, and things start to get volatile or unstable. Investors are going to sell out of the risky asset and move into the liquid safe, which are the bonds. As they sell off the stocks and buy the bonds, the demand curve shifts up, prices move up, and interest rates go down. If you think that bond prices are going to go up, you are going to buy the forwards, buy the futures, buy the calls on the futures. You're going to write the puts on the futures. You are going to buy on margin. You are going to buy calls and write puts on the bond ETFs and or the individual corporate bonds or the corporate stocks. If demand goes down for bonds, let's say that the stock market starts to rally, you're not getting very good or very high returns on the bond market. People are seeing that the stock market's going to do better than the bond market. Things are relatively stable. They are going to sell off the highly liquid, highly safe bond investments and start buying into the stock market. As they sell off the bonds, the supply curve is going to, or the demand for the bonds is going to shift down. Quantity is going to increase, and the bond prices are going to drop, and that's going to cause interest rates to go up. If you're forecasting bond prices to drop, then you are going to write the forwards, write the futures, you are going to write the calls on the futures, and you're going to buy the puts on the futures. You are also going to sell short, write calls, buy puts on the bond ETFs and or the individual corporate bonds or the individual stocks. So that's the bond. Let's talk currency next and then wrap it up. Thanks.